if the jobs number comes up a little bit higher or a little bit lower. These are just different shades of gray, if you will. The economy is not doing well, and we are in a situation where we're facing sluggish growth at best, and possibly, if we don't fix the fiscal cliff, a recession.
Okay.
I think the biggest signal that I'm seeing is dividends.
Okay, now hold on a second.
Can I tell you a little bit about that?
Yeah, I'm going to get to that in a second. But look, we've got a whole slew of numbers out today showing that construction spending is up, confidence is sharply higher. We've got 158,000 jobs in the private sector, according to ADP. Now, those are signals that we're picking up. Okay, it's not a fabulous, robust recovery, but we are picking up. These numbers would suggest that the president has a point. Are you going to contest that?
Well, let's just contest the numbers. I know ADP is saying 158,000 jobs, but they just revised September's. They first cut it in half yesterday. They lifted it slightly, but they originally reported 162,000, and now it's down to 114,000. So I don't really trust the numbers. What I trust, Stuart, is what the companies are reporting on a GAAP basis. So the fact that earnings were down, the fact that they were guiding Q4 estimates lower, and back to my point about dividends, the amount of dividends these companies are paying out are very, very alarming to me, because they're saying we have no better use for the cash. We're not investing in jobs. We're not investing in capital. We're not investing in working capital. We're returning it back to you, the shareholder, because we have nothing else to do with the money. And so that is saying they don't have a catalyst for growth. If they're not investing in growth, what is going to grow the economy?
That's a very interesting perspective. I mean, from an investor's point of view, I mean, a lot of people love to see these big-name companies shelling out more in dividends, because you sit there, you hold the stock, and you reap the dividend. But you're saying that it's a negative indicator because they haven't got anything better to do with the money.
And it's short-term focus versus long-term focus. On the short term, it increases the yield. But in the long term, if these companies aren't investing in the growth, then the stock prices can't grow. So yes, it's good for today. But if we look ahead to tomorrow, the companies paying out these dividends is a bad thing. And I think it's a leading indicator. You know,
you should, I know I go on about this, but you really should take a look at Microsoft. That thing at $29 a share is yielding about 3.5%, dead steady, $50 billion in cash in the bank. I own the stock. Are you telling me that I'm wrong, Carol Roth?
I'm not telling you that you're wrong, Stuart. You're never wrong. But I'm saying from a broader economy perspective, if we don't have these companies investing in growth, then the companies aren't going to grow. The economy's not going to grow. It's going to come from the companies first, not from the consumers.
That's a very good point,
That's just how
Carol.
it's going to work.
I'm making a joke of it, but that's a very, very good point. When companies raise dividends, as they are right now, that tells you something about their outlook for the future.
And what she's saying jives with capital spending numbers by businesses, which has been trending down.
It has.
Right?
Yeah, we should remember that. Right. Carol Roth, thank you very much indeed. Come back to New York. We're in the dark partly, but come back and see us, okay? Because we want to see you on the set again soon. Thank you, Carol.